Welcome to Moffett on Money. I'm Clay Moffett, and today we're going to talk about the current market conditions. Gotten actually a couple of questions from people who want to know should they try to jump in and capture this current energy or upward move in the market. And they've seen on FineTwit where several of the bigger folks like Guyed and Macro Alpha are suggesting that there may be a market melt up. Well, it's my crystal ball is no better than anybody else's. I don't make any guarantees. And obviously, I don't offer specific financial advice, just giving you my thoughts or opinions. On the question, will there be a market melt up? Best way I can answer is nobody knows. Nobody can predict the market successfully, particularly in the short term. And what I focus on are some of the more major moves. So, what would I suggest? What am I doing? What would I advise other people do? Well, I always look at history would probably be my first step. History has a way of repeating itself uncannily at times. Now, if we take a look at some of the past moves in the market, hope everybody can see this now. This is from January the 3rd, 2001. NASDAQ in one day soared 14%. That's pretty close to a melt up. It had a, good little run for a while. Could that be repeating itself? Possibly could. But what happened after that? Well, over the next few months, the market dropped 55%. Here, looking at this chart, you can see the market melt up, and you'll notice it was also because of a pivot. What's driving the market, as I've said in some of my previous videos, the market is trying to anticipate the Fed pivoting in terms of its policy, ceasing QT, ceasing tighter monetary policy, hiking interest rates, and either leveling off or pivoting and reducing interest rates, or adding additional liquidity to the money supply like the Bank of England did due to the pension crisis. Frankly, I see little chance of that happening. I know it's what the market wants, and when you say the market, basically talking about a very few but influential, institutional investors. If we look at the history, obviously there are times when the market rises, sometimes moderately significantly, even though it is in a longer term bear market. Did it during the Great Depression. I wouldn't be absolutely surprised that it's doing it again. The the market just historically doesn't go up while the Fed is still hiking rates. And if we look at consensus, this is it's called the WISP table, the World Interest Rate Probabilities. And it's a little tricky to read, but here you can see the dates of the Federal Reserve meetings. And here is what the current probability, according to the futures markets, or implied by some of the futures markets, is looking at 3 additional hikes. Now, each hike is about 25 basis points. So the market's still expecting a little bit over a 75 basis point hike at this next meeting. And if you'll notice, here's the prediction. By the end of the meeting, the implied rate should be about 3.85 to 4%, which right now the target rate's 3.25. The effective rate's actually hovering closer to 3.08. So that's what's embedded here. So the people who actually make their living understanding the Fed and knowing people at the Fed, which way is the Fed leaning, are still betting on another 75 basis point hike, which is what they've been doing. There's no pivot there. Now, one of the Fed governors, Evans in particular, there is some dissent on the Fed. There are different opinions, obviously. And Evans has been a little bit vocal the past week, talking about, how the Fed may need to taper its hikes. Uh, but understand, Evans is the biggest dove on the committee, on the board of governors. He was the main one talking about how inflation is transitory, and the economy will grow strongly in 2022. Which, what have we seen so far? We've seen two successive quarters of negative GDP growth. That's technically a recession. GDP comes out again I think it's Thursday. So would be interesting to see, what's going on there. But there's no, doesn't look like really, as far as the Fed, or particularly Powell, the chair, doesn't look like there's any quit in him. So I anticipate the market having some disappointment in that regard, even though, hopes have obviously sprung high. Now, the practical reality is, inflation's still going pretty strong. The Fed's still hiking rates. A lot of companies are reducing their earnings estimate. Morgan Stanley just dropped theirs another, I don't know, 4 or 5% a couple of weeks ago. There's just so much, going on in the market right now. It's really hard to predict any strong growth. I'm sitting here trying to look at the main things I look at in terms of the trends: the dollar strength, rising yields, widening credit spread, the 10-3 spread still widening. That all looks like crap. If look at some of these significant indicators of how the economy is doing. Also, what really can sustain a big increase in the market? Well, it's money on the sidelines. Now, we know that, for example, a lot of the major institutional investors, like pension plans, are feeling pinched due to margin calls. Well, with interest rates still rising, those margin calls are only going to get worse. Well, how about individuals? If we look at individuals, and this chart's from the St. Louis Fed, here you've got kind of a baseline savings rate, which right before COVID, um, personal savings were, 1.8 trillion. And then you see a lot of people, get the stimulus money, temporary savings, it comes back down, and more stimulus money, comes back down. But the thing is, particularly since the beginning of 22, it keeps going down and keeps going down, to where right now it's about 628 billion, which is a third of what it was pre-COVID, pre-stimulus. You'll notice the savings rates have been increasing here since about 2016. Well, this is an extremely low, to me, an extremely concerning number. People, looks like people are reducing their savings, maybe having to reduce their savings. If we look at money market mutual funds, maybe they're putting it in there. Well, here you see again the excess during the COVID, some of the stimulus. Well, you know, it's down where people are still withdrawing from their money market mutual funds as well. So bank savings are down, money market mutual funds are down as well. Why are people withdrawing? Maybe they've got to pay food, buy food. Maybe they've got to pay higher rents. Maybe they've got higher, health expenses, whatever. Obviously, earnings aren't keeping pace. We've had 19 successive quarters of negative earnings growth. That means each month inflation is higher than the increases in your earnings. If you get an increase, most people don't. So there's some real issues out there in terms of, are people really able to fund a long sustained increase in the market? Is there going to be a market melt up? I can't guarantee that there's not, or, you know, won't be a more significant one than what we've seen the past week. But the risk is still way too high, in my opinion. These kind of choppy markets with the violent moves up and down, back and forth, is where people get bloodied severely. So the market's not through dropping. You will have an opportunity to buy at much cheaper prices, in my opinion. And so I would just, again, wait for that day. Um, we're not done yet. We're not ready yet. So hang in there, endure some of the excitement and thrills, and you'll avoid some of the spills. Hope that helps. Do all the YouTube and Twitter things. So we're on Twitter, Moffett on Money. Subscribe here and on YouTube, if you will. And I will talk to you again soon. My time is up. I thank you for yours.